Angela, please, I mean, let us know what you think, what you've been hearing out there in the industry.
Yeah, absolutely. Thank you, Nico. So it's been interesting because I think when it comes to real estate, the fund management world or real estate like sponsors, 2020 to 2022, I think those years were very successful. I think a lot of fund managers were raising a lot of capital, and particularly with certain types of funds like DSTs, 1031s, opportunity zones, and others, they were very, very prolific in 2019, 2020, 2021, and most of 2022. So I think we had a lot of fund managers that started around that time or right before, and they kind of got used to the rhythm, right? Or that sales cycle where there was a lot of money. The stock market was, doing extremely well during the pandemic, and the people were selling houses. And refinancing and just like buying real estate. And there were all these activities going on. And I think the investment world really just got used to that. So during that time, when the fund managers were raising capital, I mean, they could literally close a brand new prospect, a lead, within the first 20, 30 days. It went from a complete stranger to an investor. But now, 5 years later, I would say that things started to slightly change in 2023. And I would say that industry really agrees that the last year in particular was a very difficult year for sponsors across all asset types, locations, and so forth. I think the fundraising wasn't as strong compared to the previous years. And now I think we're starting to kind of see the momentum coming back. But I do want to talk about, I kind of do want to address Nico's question about, okay, so, why aren't we raising capital enough? That's the question that a lot of fund managers ask themselves. And, what's the average sales cycle and so forth. And I would honestly tell you that it's very unrealistic to think that you can raise $100 million in 3 months in this current economic, state. And especially if you don't have institutional investors, on speed dial, or family offices that you have, extensive relationships with that can write big checks, and you are only going direct with accredited investors, which is what here at RevGen we focus on, because the check sizes are not going to be 10, 20, $50 million checks. You're looking at an average of $100,000 checks. So to put it simply, I think an average sales cycle, you should really consider that to be 6 months to 9 months. And if you're lucky, maybe the 3 months, but that's only if you have a marketing engine that's built. But if you're really starting from scratch and you're just building your marketing engine, building your sales funnel, and aligning your marketing with investor relations, I think it could take 6 months to 9 months, possibly a full year. And so, when I hear, especially first-time fund managers, talk about, okay, we want to raise X amount in, certain months, I always say you can do that by spending a lot of money, but know that that's gonna cut into your cost, of capital, right? And that will blow your marketing budget really quick. And realistically, if you want to have long-term success, you have to be able to budget for 6 months to 9 months. And for fund managers, maybe asking, oh, why aren't we raising enough? It seems like everybody else is doing it. But when you, quote unquote, like compare yourself to your competitors, you cannot compare yourself to Blackstone of the world or Apollo and major, major fund managers with billions and billions and billions, because they have the institutional capital on speed dial. So if you're a fund manager at 100 million, 500 million, under a billion, I think it's more realistic for you to think about a longer sales cycle and a smaller check, but that just means that it's going to take a little bit longer.